Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Happy New Year, everyone. Welcome back to Ask Rob and Rob. It's been too long. Yes, you've had lots of other stuff from us, but we love doing this. We got two great questions to kick off the year. Can't wait to get into them. But before we do, let's remind you in 2026 how you can get your question in to Ask Rob and Rob. And spoiler, the system has not changed. It's still very easy.
Yeah, if it's not broke, why fix it? So all you have to do is go to propertyhub.net/ask and you'll be able to leave us a written question for our Sunday Times column if you want to, or you could be one of our favourites. You can leave us a voice note so we can hear you right here on Ask Rob and Rob, just like Ed has done.
Hi Rob and Rob, it's Ed from Kent here. Thanks again for all the advice and help you give everybody on your channels across YouTube and your podcast. It's absolutely invaluable. My wife and I have recently fulfilled our dream of wanting to go into property development. We've wanted to do it for about 20 years and we're finally in a position where we've managed to release about 100 grand from our own home in order to start purchasing a couple of buy-to-lets or flips, which have become increasingly hard to find. So we're looking at low value flats in our area of Kent, Maidstone, Medway, which I know you say don't do close to home, but I feel the first one needs to be something that we can control for a year or so and then get our heads around maybe going further away from where we live and investing there. But I wanted some advice around a flat that we looked at on the weekend, which is a residential flat. It's a 2-bed. It's only 16 years old. It's 3 stories high, but on the ground floor are some shops, including a Domino's Pizza. And when somebody tried to buy this flat a couple of months ago, they tried with a couple of residential mortgage companies, high street banks, who flatly refused to mortgage it. And from research I've done, it's obviously because of the Domino's and other shops below it. They don't like this part commercial, part residential premises, and the fact that it's a Domino's Pizza doesn't help either. The flat's not directly affected by it. It's on the second floor. It's a good size. It would rent with absolutely no issue at all for about $1,300 a month. It's by a hospital, so there won't be an issue finding a tenant whatsoever, according to the estate agent. My issue is that this flat is probably 40-50% cheaper than other 2-bed flats in the area. And that's probably because of this issue. Well, it's because of this issue. And I wanted to know and get your take on it because the yield is, 11-12%. And if I could get some more money off, it'd be even higher. So the monthly income is great. The investment in that terms is great. However, what I do worry about is with a buy-to-let mortgage, if I refresh this and try and get it revalued in 5 to 10 years, obviously it's going to remain lower than other flats in the area. But is it going to become difficult to remortgage this even on a buy-to-let and release some money and some equity so we can carry on our journey of building our portfolio? And do you think something like this is going to continue with residential mortgages as the population increases within London and Kent and the UK? Do you think high street banks are going to remain stringent around these sort of investments, even if the loan to value is low, etc.? But is this something you'd flatly refuse to do, or would you take a chance on the investment in terms of monthly income and releasing some equity down the line, or is it something you just walk away from? Any help is appreciated. Thank you.
Ed, thank you very much for this question, because I feel we can not just help you, but many others with this. I think a lot of people will listen to this, Ed, and going, oh no, what are you doing? And I think they're right. You know what? I think if you listen to this from somebody else, you probably say the same. Because you're going against so many of the core principles that we talk about on this podcast. First of all, you are investing in an area that probably isn't the strongest right now for capital growth prospects. And you know that, you're kind of acknowledging that. You could go slightly further afield. You don't need to go to Carlisle, but just being wedded to that area is going to cost you financially. Also, especially when investing further afield gets easier and easier with the way the world is these days. It used to be a little challenging, but now it's not that hard. It requires a bit of effort, but it's not as hard as you'd think. So maybe that's something you need to get over. But what really concerns me here is that you are looking at buying this cash because you cannot get a mortgage, or you would find it very hard to get a mortgage on this property. Now, you've asked, is this something that we expect to change in the future? No. This is something that's been in place for many, many years. At Property Hub Invest, we always turn down deals like this when properties are built above these types of shops, because we know that mortgageability is really, really hard. And you may be able to eventually find a niche lender to allow you to get a mortgage, which then will help you improve your returns. But when you sell it, it will be difficult for the purchaser. So that will impact the capital values. And that's why that property is so much cheaper than everywhere else. It's not below market value. It's fair price. It's discounted for a reason. There are issues with this as an investment. For me, major issues. The lack of leverage is a big part of that. So you want to be looking at an investment that you take advantage of leverage. This doesn't allow you that. You want to, even if it's just slightly, expand the radius of where you're prepared to invest in to open up different opportunities in different areas. You can, I'm sure, get a property that's only a couple of hours away. You will not be going there every week. You almost certainly won't be going there every month. It might be just a few times a year if you're unlucky. I've got many properties in my portfolio I have never seen, and I've owned them for multiple years. Never seen them. Never want to see them. I'm not saying you need to get to the level I'm at straight away, but you should aspire to move in that direction, because when you do, you become such a better investor. The returns improve dramatically, and you're worried about creating problems by doing that. But look at the problem property you're looking at because you're making that compromise. So I really encourage you to expand your area, take advantage of leverage, use the magic formula principle that we talk about on the podcast so frequently, and change your approach, because I feel like you're going down the wrong path, Ed. I'm so glad your question is the first one of the year, because so many people will go through similar circumstances and have to make tough decisions like you are right now. But I believe that if you can navigate through this tough path, get out your comfort zone, you will do a lot better. Good luck.
Great advice for Ed there. Let's see what we can do now for Paul.
Hi there, Rob and Rob. Thanks for your excellent content. Now, I have a bit of a dilemma. I have been letting my 2-bedroom terrace house in Chelmsford out for probably 5 years, and I have an excellent tenant. She always pays on time, super cooperative, and all the rest of it. However, she is paying around £1,200 a month, and since the lease was signed 1.5 years ago, the market rents are now something like £1,800 a month. So it's going for renewal next June, and I'm in a bit of a dilemma where to actually set the rent. I'm thinking of somewhere between where it is now and the market rent, so it's like 50-50. I don't want it to turn into an adversarial relationship, and I do want to reward her for her excellent communication and how she's treated the property, etc. So what's your advice on this? Thank you very much. Bye-bye.
This is such a great first episode of the year, because this is another situation that so many people will be confronting at the moment, especially this year because of the Renters' Rights Act coming in from May. And Paul, that's some incredible rental growth over 5 years. Great for you, except not great for you yet, because you're not collecting that rent. And you've done what so many landlords do, me included, for many, many years. So while everyone in the media seems to imply that landlords are constantly cranking up the rent to ridiculous, greedy levels, no, so many people do the same as you. Just start the rent at a certain amount and then leave it there. And that's fine until it isn't. And you get to a point where all your other costs are going up. Your repairs are costing a bit more. Your insurance is costing a bit more. And it's like, oh, actually, I'm making less money now. And you could be making so much more. But the jump is so huge. Oh, what do I do about it? So what do you do about it? Well, the timing is important this year, because you said that it's coming up for renewal in June. And that means that it will be taking effect after the Renters' Rights Act has come into force. That doesn't mean that you can't increase the rent. You can increase the rent. You can increase the rent once per year. But what it means is that if tenants believe that you're increasing it to above the reasonable market rent, then they can take it to tribunal and appeal that rent. And we don't yet know, because it hasn't happened, how tribunals are going to be making the decisions. Just what's their interpretation of market rent going to be? We don't know. But what we do know, because it's just common sense, is if you make a giant leap, if you suddenly try to go up from 1,200 to 1,800, then all else being equal, your tenant is far more likely to appeal that, because it feels like such a giant jump. They're not necessarily going to appreciate that, well, this is 5 years worth all at the same time, and market rents are at that level now. So what should you do about that? Well, if your renewal had been before May, then I'd say, well, try and work it up by as much as you can before that happens, before it gets to that point. See if you can get through a bigger increase to get you closer to market rent before May. As that's not an option for you, what I would recommend doing is, if you have a relationship with a tenant, which it sounds like you do, it sounds like you self-manage from what you've said, then I'd start having open conversations about the rent. So when it comes up, you will want to put through an increase, but you probably won't want to crank it all the way up to market rent, because that would be such a jump for the tenant. So I'd have a conversation about it. I would show them what market rents for the area are and say, like, in a nice way, if you moved anywhere else, this is what you'd be paying right now. So from now on, every year, the rent will go up until we get to closer to that market rent. You don't have to get all the way there because you want to reward them. That's fine. But you will need to close the gap. Otherwise, the gap will just keep getting bigger and the situation will keep getting worse. So I'd have that conversation, then let the details depend on how that situation goes. But basically aim to put through some kind of increase. Maybe you go from 1,200 to 1,400, if that makes sense for the tenant, just as an example. Maybe do that in June. But by that point, you've laid the groundwork. So it can go from 1,400 to 1,550 the next year or whatever. But the point is, you've made clear that this is going to keep happening. You need to be prepared for it and that you're not being unreasonable by doing it because you basically showed what a great deal she's already getting. And you showed that you're going about this in a reasonable, respectful kind of way. You're obviously not trying to force her out by doing something ridiculous. So Paul, thank you for asking this question because it gives us an opportunity to answer this for the many, many people who will be in this situation right now. And I hope that helps.
Well, that's us done for another week. We've started 2026 strong. There's loads of content out on the podcast feed at the moment. Make sure you are consuming it all and taking advantage of our YouTube channel as well. Loads going out there. We'll be back with another Ask Rob and Rob, same time, same place next week. So until then, take care, have fun. Bye-bye.
Bye-bye.